Major indices well on pace for their worst 12 months since the financial crisis. But what can we hope for in the new year? To find out, we thought we'd ask our traders what chart they think holds the key to the markets in 2023. Dan Nathan, let's start off with your most important chart.
Yeah, let's talk about the largest bank stock in the market. That's JP Morgan, and it obviously has tremendous exposure to rates, to consumer credit, to housing, to corporate credit. I mean, the list goes on and on geographically, that sort of thing. And so when I think back a year ago, Mel, JP Morgan was very near its all-time highs. It was obviously considered best of breed as far as banks are concerned here. And, it really led to the downside in January and February, and it took, I think, large parts of the market with it, or at least the signaling of its leadership to the downside. Well, we've had a huge rally off of the mid-October lows. It was making new 52-week lows. It doubled the performance, the S&P 500, from the mid-October lows to just recently. Now it's come in a little bit. I think this one is going to be really important as we enter the new year, just from, again, a signaling standpoint. You look at that chart from a technical standpoint, looks to be like an epic head and shoulders top. You have that just a parabolic move that it's had in the last couple of months. So to me, I'm going to be closely watching JP Morgan, especially their earnings when we get them in mid-January, and what Jamie Dimon has to say about the economy here and abroad and what he sees for just the course or the pace of rate increases. I know that they're going to end, but really, how long will they stay this elevated for?
Yeah, and how would he characterize the storm that is still brewing? Because that is sort of the headline that he made the last time he had some significant commentary about the environment we were heading in, whether it be could be a Hurricane Sandy or it could just be a passing storm here. Jeff Mills, would you be watching JPM as well?
Yeah, absolutely. I'd be watching banks overall. I think I've mentioned it a number of times in terms of the relative performance. JP Morgan's done better, but banks overall, the relative performance relative to the S&P 500 has not been great. It's recovered a little bit over the last week or so, but I'd be watching that really closely. And I just think overall with banks, even with some of the better names like maybe JP Morgan or Bank of America from a credit standpoint, I just don't want to be heavily exposed heading into a recession. And that really is our base case. I mean, JP Morgan said it themselves, I think maybe during their last earnings call, that if you get unemployment to 6%, we've never had a recession with unemployment below 6%, loan loss reserves go way up. You see loan demand come in. And I think that ends up being a headwind to earnings. So even at these valuations, which look pretty attractive, I think banks end up being a tough spot from relative performance perspective in 23.
So he likes the chart in terms of what it may indicate, Guy, but does not like the stock. How about you?
Well, I mean, Dan was channeling his inner Carter Braxton Worth with that head and shoulders formation. And, JP Morgan, deservedly so, is the most expensive on valuation, depending on whatever metrics you look at, it's there. But the question is, in this environment, an environment we seem to be going into, is this the right valuation? And I think probably not. I still think some of these bank valuations can go lower. And I think it's going to be tough sledding in the first half of the year. And it's going to be on the back of what I bring up as my chart of the year. In the business, that's called a tease, by the way.
A tease, a deep tease, because your chart's going to be last. I'm telling you that up front. Courtney is up next with her most important chart. Court, what are you watching?
Yeah, I would take a look here at the iShares MSCI China ETF. And I know we've talked a lot about emerging markets, kind of our optimism in China here. This chart's actually pretty fascinating here because this hit a bottom at the end of October, which actually well before that they abandoned their zero COVID policies. So I know that that's really what's top of mind on investors' minds right now. But this bottomed well before that, and I think it's really showing you that this is due for a rebound. You're kind of almost seeing this V-shaped recovery here. And realistically, as we look into 2023, China, which is the second largest economy in the world, finally reopening. Really, when you look at GDP or corporate profits, is really one of the only large economies that is expected to have decent growth next year. So I definitely think this is something you want to take a look at going into 2023.
Yeah. Dan?
Yeah, I'm less optimistic about what China has to offer for global growth. And a large part it has to do with just the way in which they've managed COVID, the way they're coming out of zero COVID, the way in which the globe has decided, I mean, the West at least has decided that they cannot be dependent on Chinese for the cheap manufacturing that they've relied on for decades here. And so I think deglobalization is going to continue to be a thing. And I think that's going to ratchet up this economic war that we're having with China. So to me, I think that we're emerged from COVID as as just this bipolar world on a whole host of different levels here. And so I just don't think we're going to have the integration with the Chinese economy that we've had over the last 10 years, which has really been a boon since the financial crisis. So to me, I'm less optimistic about China.
I think the point that Courtney was making is really interesting in terms of where we saw the most recent bottom, and that is the end of October / beginning of November. We saw it for many of the individual stocks that we watch typically on the show, such as an Alibaba, a JD.com, even a New Oriental Education. And so what did that tell us about where China was headed if those stocks were bottoming months before zero COVID was lifted? Guy, I mean, do you look at this maybe now that was it? You sell the news, so to speak?
Yeah, well, listen, you know this, Alibaba's been in a downtrend basically for the better part of 2.5 years. And you've seen 30 to 50% rallies off the bottom. And I think what you've just seen from that low of about 58.60 on an intraday low, that $63 close is exactly that. But the reopening trade in China, all right, we'll go down to the next road. I mean, that would be very bullish, one would think. But does that make the Federal Reserve's job that much harder? Because one would think if China does reopen in a meaningful way, it's just going to add to the already pretty visible inflation problem. So, I don't know necessarily that a China reopen or a robust China helps in the long run what we're trying to combat.